we're a little bit late today, but I have one of my students about to make his final presentation from the Valuation Masterclass Bootcamp. Nikhil, are you ready to go?
Okay.
All right. I've just shared your screen up onto the projector. So I'm going to exit now. And as soon as I exit, then you start. Okay.
Okay.
I'm exiting now.
Okay. Hello, everyone. Albertsons is a company which is at mature stage, but even if after it was established long ago, it still reacts to the trends and innovations in the market. And that is why I believe that leveraging emerging trends. I initiate coverage on Albertson with a recommendation based on a target price of $23 implying an upside of 26%. I derive my target price from a DCF-based valuation using a WACC of 10.2% and a terminal growth rate of 2%. For my highlights, I believe that there are two trends that we have to look at. First of all, the online growth change in the consumer preference toward healthier food. We talk about the slight improvement in cost management of Albertsons. Moving on to the background of the company. It was established in 1939 and with over 2,200 stores in 34 states and the District of Columbia, it is among the five biggest food and drug retailers in the United States. Albertsons has a market cap of US $11 billion. Albertson holds approximately 7% share of the market, securing the fourth position in the industries. Now moving to the actual stories most important to this presentation. First of all, Albertsons can capitalize on the growing trend of online grocery shopping. The US grocery delivery market is expected to reach revenue of $457 billion US dollars in 2024, growing a CAGR of 12% to $155 billion US dollars by 2029. Digital sales made up about 5% of total revenue, but their growth for fiscal 2023. This increase in digital sales was one of the main reasons for the overall revenue rise. Now I believe that Albertson does have the capacity to capitalize on new trends. As I explained to you earlier, that Albertson reacts to new trends. Also, during the COVID-19 pandemic, Albertson was successfully and effectively able to capitalize on the trend of grocery shopping because people were now purchasing groceries from the comfort of their home. Secondly, changing consumer preference won't be an issue for Albertson. Around 50% of Americans say they're actively trying to eat more healthy. 50%, 55% are willing to buy a premium for healthy foods, according to by Deloitte. Most of Albertsons' revenue comes from non-perishables and fresh products, and that is why I believe that this is a major and significant trend. This change in preference allows Albertsons to capitalize on its organic banners. I expect Albertsons' revenue growth to increase in the range of 2%. Thirdly, slight improvement in cost management. I expect a slight improvement in cost for Albertsons. Currently, the increase in cost is due to the ongoing development of digital and omnichannel capabilities, Kroger merge-related expenses, higher employee costs, increased store occupancy cost, and additionally, I believe these costs will decrease over time because they are not expected to persist long term. These costs are temporary and they come continue this level as expected in future. In the long term, furthermore, Albertson is also planning to close stores and shops, which will impact the margins as well. Moving on to the industry analysis, I believe that earlier and current options are the future of this industry. To understand this industry, you have to understand few things. First of all, it is a non-cyclical industry that produces necessities, and secondly, it has low volatility and minimal risk, steady growth opportunities. Costco, Wholesale Coop, and Walmart dominate the market with a combined 60% market share out of total market size of 1.2 one leads globally, the market with 76% market share, followed by Canada at 8%. The food industry consists that produce, sell, and distribute essential products, and that is why that market is of vital commodities and high resilience to risk. Secondly, consumer demand for convenience, which is also the premise for stories, the comfort from their home. The shift in preference is expected to stay with the grocery delivery industry forecasted to grow at 12% CAGR from $7 billion US dollars in 2023 to $1.3 trillion by 2029, according to Statista. Hence, plays effectively of automation and technology to deliver controlling cost to sustain profitability in this hyper-competitive industry. Third, strategic growth. Why I say this is strategic growth? Because first of all, this is a hyper-competitive industry. You can't just increase your and expect consumers to stay loyal to you. They will move to other options. Despite being a non-cyclical industries, companies are not immune to inflation and things like that, increase prices. And that is why I believe that if you want to stay in the competition, you have to innovate and pick up on new things. And that is what Nestle has done. Moving on to the quarterly results, I believe that gross profit, Alberts reported in first quarter of 2025, gross profit of 6.1%. The company saw a 0.7% year-on-year decrease in net margin, 0.9% year-on-year decrease in revenue. Also, DCA reported the first quarter of 2025 recurring EPS of $0.5, just negative 32%, negative 5.4% quarter-on-quarter. Moving on to the consensus estimates, about 75% of the analysts hold a neutral view on Albertsons, and 4 analysts have issued indicates a potential 32% upside, predicts a decrease in revenue growth from 2% in 2024 to 1.4% in 2025. Moving on to the revenue structure, non-perishable items have been the top contributor continuously. Frozen food, canned goods, dry ingredients, paper products, and like beer, soda, water, and wine. Fresh items contribute about 32% and include fruits and vegetables, deli, meat, bakery products, dairy, eggs, and cheese. Additionally, of the total revenue comes from the retail pharmacy, which is in line with the average in this industry. Also, Albertsons generates 5% of its revenue from the fuel segments, with 403 gas stations nationwide. Moving on to the ACA, ACA is active related to 1,810 non-financial companies in USA. The most important thing I want you to look at here is momentum. It shows below average momentum related to its peers as the revenue growth and EPS growth has decreased over the years. Moving to world-class benchmarking, I believe that profitable growth ranked about neutral consistently. There is room for improvement in profitability and growth for the company. Asset efficiency has consistently ranked number 1 since 2021. It has shown world-class performance consistently and comprised the main driver of the overall profitable rank. Expense control, on the other hand, is very poor. Growth has decreased in comparison to 2021 and 2022. For profit and loss statement, I believe that there is going to be an increase in revenue due to the trends I have mentioned above and according to my stories and my arguments. Moving to balance sheet, I want you to look at next fiscal years. I believe that these assets are going to increase because of long-term leasing and Albertsons planning to expand. Have any comments on liabilities? I will move to the cash flow statement. For cash flow, I want you to look at dividend paid, and you will notice an unusually high dividend in 2023, which is also one of my risks, and that's why I highlighted here. For ratios, I believe the current ratio is mostly stable, with one that it was so during the COVID-19 pandemic period. For visible collection period, it is, I believe the net profit margin is decreased slightly, but I believe that over time it is going to increase because the costs are not consistent and they are going to decrease overall. For free cash flow, I have estimated a tax rate of about 2. I believe that there is going to be increase in capital expenditure in my forecast. For relative valuation on the forward 2025, PE multiple Albertsons trades at a discount compared to the consumer staples sector in the US, Asia, and the world. Thus, Albertsons seems cheaper than a 25 PE of 8.2. I expect its EPS growth to be negative in 2025 due to the drop in net profit. The PEG ratio is not meaningful to be used to value Albertsons. Moving to a PB to PE ratio, on the forward 2025, PB multiple Albertsons looks cheaper compared to consumer staple sector in the US and globally. I forecast its return on equity to be around 24% in 2025, higher than the sector in the US and globally. This results in Albertsons trading at a big discount based on the 2025 PB to ROE multiple, which means it's undervalued comparatively. Moving on to the valuation, I assume a risk-free rate of 3.5% and market equity risk. I assume a beta of 0.8%, which is higher than its previous average, resulting in a COE%. I forecast the capital structure with around 40% debt to capital, terminal rate of 2%, and free cash flow to the firm because Albertson is a mature company. In this scenario, I anticipate a gross margin of 27.8%, leading to a value of $23 per share based on the FCF methodology. This represents a 26% upside compared to the current market price. Moving on to the sensitivity analysis, I believe that with a base case of 27.8% gross margin, if there is a 2-point increase in gross margin, the valuation of the company on the basis of FCFF to about $37.5, and conversely, by decrease in 2%, 2 points, I believe the valuation goes down to $9.6. Coming to the risk, I believe the main risk here is inflationary pressure. Even though this is a non-cyclical industry, the consumers are still price sensitive. If a company increases its price, the consumers seem to have other options available, and that is why retail inflation does have an impact on the company, and I believe that is a major risk for the company. The net profit margin decrease that we see are also retail inflation is also a factor in that. Secondly, merger agreement with Kroger produces uncertainty in the market, and that is why the share price of the Albertson is also trading at lower levels than it usually does. Thirdly, opportunity cost of high dividend paydown. Albertson announced a $4 billion dividend in 2022. The dividend was funded by $2.5 billion in cash, $1.5 billion in debt. The company also has large interest payment obligations. Although high payment boosts confidence in the company from investors' company perspective, it also takes away the company to invest to remodel stores and enable online shopping and retail workers. Fourthly, it is dependent upon the availability of significant amount of energy and fuel. And that is why I believe that leveraging emerging trends could prove to be useful for Albertsons. With that, I'd like to end my presentation. I'm Nikhil Nautiyal.
Excellent. One of the questions that we're getting from the from the crowd is, can you update what's happening with the merger and how should we think about it in relation to the valuation and the opportunity with Albertson?
The opportunity. Currently, the merger is awaiting from federal court in the US, so it is a very dicey situation for Albertsons. But most of the analysts in the industry don't believe that the merger is going to happen because federal trying to basically stop the merger from happening.
And what does it mean if the merger doesn't happen? If I buy the share today, if it gets announced that the deal is off, does that cause the share price to go down or up, or there's no impact?
It could definitely cause the share to go down because it is uncertain, and some investors are basically expecting the shares the merger to go through because the Albertson and Grover will definitely have more power to buy their input, have more bargain power because of that. And I believe that it's going to cause a decrease in share price. But also, Albertson is supposed to receive a high amount of money from Grover if the merger doesn't go through. So that could also instill confidence in the investors.
Okay. And last question is from Mohammed as well as Momin. They're asking about e-commerce. Like, do you know what percent e-commerce is as their total revenue? And what are the threats there with e-commerce? Is there no barrier to entry for competitors or?
Right now, I believe that their total revenue, about 5% comes from e-commerce. I do believe that it is a small amount, but I believe that over the years it is going to increase, because I believe that it is going to increase in proportion of what the trend is. People are not going to affect us or just buy groceries over just suddenly. That's why I believe that Albertson is also using omni-channel capabilities, where it is available both online and both offline. I believe that e-commerce is a market where competitors could easily come, because it is a market where you just have to cater the logistics. But I believe that since Albert 2200, it is available at all the points in the market.
So they've got a good distribution network.
Yes.
So how does it feel to graduate from the Valuation Masterclass Bootcamp?
I was waiting for this moment and I feel relieved to finally graduate. It feels absolutely amazing. What course is? It was really hard, but it is a comprehensive course, so you have to give it that.
And how would you describe the transformation that you went through?
News or about any third-party research, I don't completely buy everything that they are saying. Now I analyze things. Earlier, I used to buy everything that I used to see on the news. Really good transformation that I had.
That's a major a major improvement. I'm going to congratulate you right now. I'm going to take you out of this and then I'll come and see you in just a second. So well done. And I'll talk to you in just a second. Well, that was interesting about Albertsons. And is it a good time to enter? I thought it was, it seems very cheap at this point. And if there's just so much uncertainty about the merger, maybe all that uncertainty means that when certainty comes, no matter what happens with the merger, the share price could go up. What do you think? Well, if you want to build a competitive advantage in company valuation, like we just saw Nick Hills built,